So part of this is going to be of what we didn't finish last time, which is the financial statements. So I'm gonna be moving from the financial statements and moving through, and I see nobody's attending the session. So I'm just gonna record this session, and then I'll just ask you guys if you do want to continue with these sessions. If not, then I'll just stop running them. Okay, fine. So I've decided to do it in full detail, and then I will you'll watch what you need to watch. So the last thing we were at number 7, where you had a mortgage loan. So I just want to show you something here. I'm gonna draw like a timeline. Actually, let me actually draw it. Can I access my drawing feature? Like draw. Where is it? I want to draw, and then it's usually here. It's weird. Mm, Let me close it and open it. Just save. See if we can get it back. So the mortgage bond was registered on the 1st of May. Remember, our year runs from the 1st of April to the 31st of March, right? So it runs, our mortgage loan was registered a month later, right? Not from the beginning. You'll see the initial interest is set at 12% per annum, which is raised to 14% on November the 1st, 2016, and dropped to 10% on the 1st of January 2017. Yes, there we go. Draw feature. That's all I wanted. Okay, here's this thing now. Okay, so I'm gonna draw my timeline first. So it's very important for you to draw your timeline. So the 1st of April to the 31st of March, right? The mortgage loan was registered on the 1st of May. Fine. So then the interest, you see it says the initial interest, okay, sorry. The initial interest was set at 12% per annum, right? So from the 1st of May, the interest was 12%, right? On the loan, on the mortgage bond, which was raised on the 1st of November. It was raised to 14%, right? So from the 1st of May to the 1st of November, I mean, the 30th, October is the 31st, right? Yes, the 31st of October, the interest was 12%. So I'm going to go over here. I'm going to say 1. Okay, no. Lying to you. So from the 1st of November. So from here to there, we had 12%. Fine. So then from the 1st of November all the way to the 1st of January, it dropped. Sorry. So from the 1st of November is 14%, right? And then it dropped to the 10% of the 1st of January. So from the 1st of November to the 1st of January, we are sitting at 14%. Okay, let me do that one. So like here, I'm gonna do it below, so not too confused, or maybe not. You can just go higher or lower. Okay, so this is the 1st of January, and I'm gonna go below. And then it dropped to 10% the rest of the. So it says there, it dropped to 10% on the 1st of January until the rest of the year. Okay. Then, so there's the interest on loan portion of it. Then there is the short-term loan portion of it. Okay. So if I look at my trial balance now, so if I go up to my trial balance, remember my trial balance now shows my balances as at the 31st of March, so at year end, right? If I look at my mortgage bond, it doesn't say the 1st of April, so this is my mortgage bond at the end of the month. Now, want to take out, okay, no need to take out a calculator. I'm gonna write this down here. So our mortgage bond is 0.5 September to the 31st of March. So we have September, October, November, December, January, February, March. That is 7 payments, okay? So we have 7 times 30,000, right? September, October, November, December, January, February, March. Okay, fine. So this will give you, let me just see. So 7, okay, I'm going to say equals 7 times, can I have 7 times 30, 1, 2, 3. That gives us 210,000. That is our short-term loan portion. You can immediately go to your statement of financial position and put that 210,000 there as your short-term loan. Okay, fine. So this gives us 210. 1.5 plus the this is what we're going to do now. I'm going to make this a different color. Let me take this one. So we're going to do. So we're going to calculate interest from the 1st of, what you call the 1st of May to the 1st of November, right? So, but before we do that, let me see, this is October, sorry, this is November. So the 1st of, what you call September, the 1st of October, the 1st of December, the 1st of January, and the 1st of February. 1, 2, 3, 4, 5, 6, and 7 will be the 31st. September, October, November, December, January, February, March. Cool. The 1st of March. So there'll be another payment here on the 1st of March. So these are where the 30,000s are. So now I'm going to calculate first the interest portion of this time period, right? So from the 1st of May to the what is this, to the 1st of September, that is May, June, yeah, May, June, July, August. That is 4 months, right? 4 months. Everything after this is 1 month each, right? So now we're going to go 1.710 mil multiplied by 4 months over 12 months multiplied by 12%, we get an answer. So if you look over here, the first one here, I have 1.710 mil multiplied by 4 over 12 multiplied by 12%, I get 68,000. That is my loan portion right there, right? Now, when I come to the 1st of September, remember now you pay the first 30,000, right? So your loan is going to be 1.710 minus the first 30,000 multiplied by 1 over 12 multiplied by, look at this, we're still under 12%, right? So you'll see the second one there, we have 710 minus 30,000 multiplied by 1 month over 12 months multiplied by 12%, and you're going to get that 16,800, right? Then the next one following that is from October to October to November. Now you're going to subtract an additional 30,000 here. So you're going to subtract 60. So you're going to go 1, let me go down. 1,710 minus 30 minus the second 30 multiplied by 1 over 12. We are still under the 12%, right? So this is for that one, that is for this one, and okay, this one is for until there, this one is for until there, and this one is for until there. So this is the last one under the 12%. So if you go over here, you'll see 1,710,000 minus 60,000 multiplied by 1 month over 12 months, multiplied by 12%, and then you're going to get that 16,500. Okay, fine. Now, the next one, obviously going to say 1.7 million, right? We are here now. We're moving from here to here. So you're going to say 1.7 million minus 330s, right? 330,000 because now there's the one that you pay on the 1st of November. But now the interest is 14%. So you'll see here the interest is now 14%. So 17 minus the 30,000, which will give you 90,000. So I'll just write it down for you guys. Maybe in a different color to show that we are now in new territory. Let me make that maybe like green or something. Maybe dark green. So 1710 minus 1 minus 2 minus 3 multiplied by 1 over 12 multiplied by 14%. Okay, so this was to that date. Fine. So there we go over there. The next one, 1, 7, 10 minus 1, 2, 3, 4 over 1 over 12 multiplied by, so from December to January, we're still under 14%, and that is all the way to 1. So if you go over here, you minus the 4,000, 12,000, multiplied by 1 over 12, multiplied by 14 over, 14 over 100, which is 14%, and you get that 18,500, right? Now we're going to go to the new territory of the 10% now. Okay, and I'm going to make it a different color again, make it red. So now we have 1710 minus 1, 2, 3, 4, 5, right? Multiplied by 1 over 12, multiplied by 10%, okay? So if you come over here, you'll see we have 1.7 minus 150 multiplied by 1 over 12 multiplied by 10%. So initially, what we are doing here, in the beginning, we owe a loan of 1,710,000, right? By the thousand. So obviously our loan will have to decrease. And then our last one will be the 1710 minus 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6. Multiplied by 1 over 12, multiplied by 10%. And that will be, so this is the end of Feb. This is the beginning of March. And this is the end of Jan, right? So from here to there, and then this one is from here to there, and then this one is from here to there, and then we still have another one. So that's why you have this one here, 17 minus the 6, 30,000 multiplied by 1 over 10, and then the last one over here, over here minus. So now, remember this is 6 now. We have 7 payments. Minus 7, 30,000 multiplied by 1 over 12 multiplied by 14, by 10%, sorry, by 10%. Why did I make that? That is weird. Yeah, that is weird. Okay, just gonna fix that. 100. Gonna change a lot of things. I really hope that this amount is taken immediately where it needs to be taken. Let me just see. This would be accrued expenses, so it's right there, and it will also be interest on overdraw on loan. There we go. Okay, fine. So that's what we're gonna do with the interest. So if you look at your trial balance, okay, if you look at your trial balance, so this is how accruals will work. You don't need to know accruals, but I'm just gonna tell you anyway, right? So if you look over here, you will see in your incomes and your expenses, there is no interest on loan. So you don't show that you paid it. It means that all this amount of money here, you owe it, right? So it's accrued. It means it's money that you owe. You're supposed to pay this year, but you haven't paid it. So it's accrued expenses. That's why I put it under accrued expenses. And then where you would put it, you'd put it right there under interest on loan, right there. Okay, fine. Then I showed you what you do with the 30,000. I showed you what to do with it. Is a short-term loan portion. Okay, fine. Let me see. Let me go back. So then a tenant moved into the building on the 1st of August and paid 10 months worth of rent. Okay, let's count. So we have August, September, October, November, December, January, February, March, April, May. Okay, so it's 2 months extra that a tenant has paid. So this is income received in advance. Okay, you go to the rent. Where's the rent income? Right there. This is the rent income. 657.75. Right? You receive 2 months in advance. So you're gonna go here. Where is it now? Where's my the income received in advance? You're gonna say 650.77. You're gonna divide it by 10 months. Remember, it's 10 months of rent multiplied by 2 to get the portion that is extra. That's what you do there. That's what you're gonna put it there. Okay, fine. Let me see what's next. Interest on fixed deposit was accrual. Okay, let's see what's going on there. So we're supposed to receive this interest on fixed deposit. So first of all, it's going to be maturing. It's going to be maturing on the 1st of August, which is not like more than 12 months from now. Okay, so but they say it's accrue. Okay, it's accrue. Okay, so let's see. So accrued income over here. Okay, so we have the interest, right? So we've had it from since August, right? So you're gonna count from August. It does say August the 1st, right? Where is it? Fixed deposit. Where are you? Where can I stay? You go. August, September, October, November, December, January, February, March. 8 months, right? So 8 months of interest supposed to be received, but it wasn't, right? Fine. So now we have 5,900 multiplied by 8 over 12 multiplied by 12%. And I'm going to put that 4 over there. And then I'm going to take it there. That is my interest on investment. Okay, fine. And then let's see what's next. April's advertisement cost has been paid to Rukia traders. Remember, we are meat lovers, right? So we paid 1 extra month of advertisement cost. So let's go over here. Let's see what's going on. Advertisement cost, where are you? There it is. We have 50,000 here, right? So we know we can divide this by 13 because we paid an additional, right? And this is us paying. So we paid expenses ahead of time. This is prepaid expenses. So I'm going to say 50,000 divided by 13. I'm going to get the advertisement cost per month, and that is going to be the actual prepaid portion of it immediately. I don't have to multiply by anything. Okay, fine. And that is it. Okay, fine. So if that is it, everything has been done. So interest on income, you're going to take it from your trial balance. So let's go to our trial balance over here. Interest on income, there it is, 5,000 plus the 44 will give you the 49. Expense, let's see. Interest expense is 6,000. So the 6,000 plus the overdraft. Do we have interest on overdraft, or did I just calculate it? I just calculated it. Okay. So look here. My bank account is sitting there with a negative balance of 29,000, right? There's a 10% interest on that. So 10% multiplied by 29,000 will give you 2.9. Plus that one of loan will give you the total there. That was done. This was also done, I believe. We just completed this one. We did the allowances, and now just did accrued income and accrued expenses. So now look at here. SARS. We have SARS here of 18,000 over there, of 35,000. You agree that the 18 is bigger than the other. So now we're not going to have an input VAT. So input VAT is when we can claim back VAT from SARS. Like, so this is if we buy like a car for the company, one that will fall under companies that you can claim off, like for instance, a motorcycle, a taxi, but a taxi, a minibus, not a taxi, a minibus that, you know, those minibuses that don't have windows at the back, stuff like that, a truck, you can't get a sedan. A single cab, van, also you can claim back VAT on that. Where was I going with this point? Yes, that will be your input VAT. That will be a VAT that you claim from SARS. That's the 3.5, but it's less than the 18,000. So you're just going to pay SARS the difference. So you're going to put nothing over there. Fine. And then you're going to have your trade receivables. It's going to go to your statement of financial position. Your mortgage loan, this is what you're going to do. You're going to say the 1,500,000 minus the 730,000, you're going to get 0.29 million that you still owe to the to whoever you owe on that loan actually. Then you have your creditors control. Did I do anything about it? No. Creditors control, these 250,000, nothing else happened. So there it is. Income received in advance, I did it. The what you call the accrued expenses, I did not change this. Give me a second. I'm not sure I wanted to take that to source. Anyway. Okay, since I didn't put it here, I'm just gonna put 3.5 here. It'll still balance either way. Whether I subtract it from here or what, it'll still balance out either way. Fine. I think everything else will be fixed by now. Okay. So now that is done, that is now done. So you come here to your statement of financial position. So remember, everything comes from what you have already done, right? So like for instance, your property, plant and equipment is this 4028. That's the one over here. Your financial assets, let me just see. There they are. Where's my fixed deposit? Here's my fixed deposit. There's my fixed deposit, 55900. Okay, fine. My inventory, we did it. So if you look at the inventory, that 88500 is that 88500. Trade receivables, that 346972 is that 346972. Cash equivalents, that 7.5 is that 7.5 here. So now you're gonna add these two up. You're gonna get 4.5 mil. You're gonna add these three up. You're gonna get 442,000. These two together will give you that 5,018,000 rand and 747 rand. Fine. Then you're gonna take this amount and you're gonna put it here because remember, assets equals owner's equity and liabilities, and this is the total of your liabilities and equities, right? Fine. Then you're gonna take your trade payables from there and put it there. Remember the short-term loan of the 730,000s, right? Your bank overdraft of the 2.9 minus that 5.6 that debtor was going to pay you. If you forgot the debtor, I don't blame you. We did it like last week. There it is over here, the 5.6. Fine. Now just move to the next one, okay? Where am I now? Okay, I'm going to have to say. Okay. Fine. Then you're going to add all these together. You're going to get 886,000 Rand. Your long-term borrowings are this here that you had calculated at note number 7, and you're going to include them there, and then you're going to total them. Then this minus these two will give you equity or your capital, your last capital. So what you would do is you'd write note 3, 4, 5, no, however you name them. You see like this, you'll put 8 over here. That's how you'll complete your balance sheet. Fine, your statement of financial position. Now, your income statement. Okay. Then I'll go back to this thing here. So I'm gonna go down now to the nominal section. So usually you use so for your statement of financial position, it's your proprietary, which is capital and things, and your assets liabilities, right? And for your income statement or your statement of profit and loss and other comprehensive income, it's gonna be nominal account. You're fine. So your sales, you're gonna take your sales figure here. Do we have sales returns? Yes, of 10,000. So if you go over here, you'll see you have that minus sales returns of 10,000. I see there's another 10,000. I wonder what that is for. Let me just see. 10,000. Did I just add it again? Settlement discount granted? Maybe. Okay. So it's the 10,000 for sales returns and the settlement discount granted will also reduce our sales. Fine. Then our cost of sales. So if you go over here, you'll see our cost of sales is sitting there at, where is it? 722 as you see up here. But remember, there was missing stock. So if I go back up to my note 4, I think the inventory one. I think it's note 4. You'll see that I had the 1.2 of drawings, right? And I had the 1.7 of just missing stock. That's what that 1.7 is over here. So I'm going to subtract that. Then I'm going to say sales minus my cost of sales will give me my gross profit, right? So the format that you use, know the format that you're supposed to use in your test, right? But whether you do it in this format or the other format, it's still a financial position, right? So you see that over here, I did not include my introduced capital, my new capital, my balance, my drawings, and my profits. Those things are down here in my statement of changes in equity. It's on a separate statement. Fine. Then you're going to get your gross profit. Fine. Then you have settlement discount received. Okay, so, oh, well, you have your other incomes. So I'm going to go over here. So other incomes will have a credit balance. So credit balance here, settlement discount received 8040. There you see it over there. I have my rent income of 550, but remember, some of it is not supposed to be there. So I'm going to say this amount. Did I say 650 or 550 for my rent? Okay, it's fine. Minus B52. So if I go to B52, let me see, B52 will be that income received in advance. That was that rent that we received in advance. Okay, fine. Then I have, hold up, why did I open that now? I have to close it when it opens. Okay. Then the next one is going to be my commission income of 550. Oh, it's opening on this side. Just close that. And you see it over here, 550. Fine. I have credit loss. No, what is this? This is interest. Okay, never mind. And then if I scroll up, I have credit losses recovered of 1.9, credit losses recovered of 1.9. Now, over here, I need to see something. Where's my debtors? Okay. So my allowance for credit losses increased, so that's an expense, right? So my allowance for credit losses adjustment will be an expense, but my allowance for settlement discount granted decreased, so that will be an income of 800 bucks. So the expense of 990 and the income of 800 bucks. Okay. So allowances settlement discount granted income 800 bucks, and then where is my allowance for credit loss adjusted expense of 990? Okay. So that's where those two go. Fine. Then you're going to add up all your incomes. You're going to put them there. You're going to add them with your gross profit. You're going to get your gross income. Then the expenses now. Okay, so the expenses are going to be on the debit side. So we already done sales returns. So the first one will be our salaries and wages, which is 350,000 over there. The next one is advertisement, but remember we paid extra for advertisement. So I'm going to go over here, minus B36. B36 is this one over here, prepaid expenses. Remember we paid one extra month. We paid for April. Okay, fine. So you see that affecting your statement of profit and loss and affecting your statement of financial position. All right. And then let me see now, advertising. Then the next one is going to be for 59,000. But remember now, there was some stationery and 1,000 Rand that was left over. So you're not going to include it there. So you'll see I have that minus the 1,000. Fine. Go back up. Settlement discount granted of 10%, 10,000. I wonder what that other 10,000 is then. That is weird. Maybe just an error on my part. I'll just remove it. But I feel like it's supposed to go to somewhere, so I'll just leave it for now. The one in sales, that's the one I'm thinking about. So the 10,000 here will be the 10,000 there. Consumable stores of 9. Then remember the consumable stores, actually, there was also like a change of 2.5 that is left over. So you're going to subtract that. So over here, this minus the 2.5. All right, fine. Then we have the credit loss of 30,800. So here's my credit losses. Credit losses over here. Plus, I have more credit losses, remember, of 34,000. If you don't believe me, we're going to go back up. Remember in trade debtors, 34,000 was credit losses as well. Okay, so don't forget that. Then we have our interest expense, which is going to skip for now. We have a government levy, which is 500. So okay, I'm just going to add all of this to bank charges. So we have government levy, transactional fees, and monthly fees. So there they are, government levy, transactional fees, and monthly fees. So then our depreciation will be for the year. So if I go to my depreciation for the year, where is it? Okay, so I'm going to add all of these up. So let me just show you the calculation here. So I said C20, D20, and E20. Okay. So these two, all those three amounts will be added. So that's where you'll get your depreciation for the year. So it's your depreciation for this year. Remember, depreciation is an expense. Okay, fine. And then you're gonna add up all your expenses. You're gonna get your operating expenses, which is you're gonna subtract from your gross income. You're gonna get your profit before financial costs, right? Did not mention interest income, and we did it. Okay, so interest income, our interest income and interest expenses. Remember, interest income was 49,000. Interest expense was 263,000. So interest income is over here, 49,000. Then our interest expenses here, 263, which you're gonna subtract from our profit, and we're gonna get our profit there before tax. Fine. Then our statement of financial position of our change in equity. Remember this amount of, where is it now? Why is this not scrolling up? Okay. Owner's equity of 2.8. That is going to be our balance, our closing balance over there, right? So now our opening balance of capital, if we look over here, it is sitting at, scroll up, 910. Okay. So if I go here, a lot has happened. Okay, fine. We'll work it back. We're working it back. Okay. Drawings. Drawings, we have drawings of 300,000 plus that 1.2 that we already subtracted. If you forgot, it was number 4. Where is it now? Number 4 over here. 1.28. Fine. And back down here. If it will get there, let me see. Then I'll over there. And then our additional contribution is the 250. Remember, the 250 is this one over here. Owner contributed equipment with the cost of 250. And then if you work it backwards, so you say B109, which is this one, and then you're gonna subtract you're gonna say minus all of these. So obviously this is going to be subtracted and all that stuff. You're gonna go back to the beginning. Fine. So that is your financial statements, right? Then we have your cash flow statement. So for your cash flow, I decided to draw this. So all in all of this, what it is just you knowing your format. You just need to know your format, right? So you have your financial position statement here. 2021, okay, this should be 2019 actually. 2019 to 2020, so I just have changes here, okay? Fine. I just have changes. So fine, close that. Okay, fine. So you just need to know your format. So you have the indirect method of cash flows and you have the direct method, right? So now with the indirect, you're gonna start here. So you have your income, your profit and loss statement over here, you're changing equity down here. Fine. So I just made these amounts multiply by 80% just to make them less so that we are able to calculate them. Fine. So you'll see here our income, our sales rev is that amount over there, right? So now what we need to subtract is going to be our cost of sales and our other expenses. So you see it's our cost of sales and operating expenses. You have those. That's what you're subtracting over there to get your profit, your operating profit over there. Remember now the interest you paid, here it is, interest expense of 263 over there. I'm just going to scroll up like this. So that's what you're going to subtract. And then the interest you received is that interest income over there. You get to 1.3. Okay, fine. So now the other thing that you need to do. I just want to see something here. Am I missing something? I subtracted that. Did I add that? No, I didn't add that. Okay. I didn't add this. That's why my number is different here. So my sales rev, I'm going to add my other income as well. Now my stuff makes sense. Or it should make sense. Let me see. So this one plus that one. Fine. I'm going to subtract the interest income because it's added down here. I'm just going to say, because then in this balance, it's already included. I'm just going to subtract it there. And then everything makes sense. So your balance at the end, your profit should be obviously equal to what you see over here, right? Fine. So this is your statement of profit and loss. Now, when you're calculating cash flow, you need to bring back all the costs that you subtracted that are not actually costs, right? Like depreciation for one, sorry, not for once. So your depreciation is sitting here at 498 and it's subtracted. So we're gonna add this back, right? Now your sales rev, you need to subtract the portion that is credit sales because you didn't make the cash, right? So here, your trade receivables, I took my trade receivables, right, for 2020 and I subtract 2019 to calculate the change. So the additional credit, what you call credit sales over here. I did the same with my additional credit purchases. Subtracted, I got the difference between these two to get the additional to add it back. So I'm paying for stuff that because we can't show that we are paying it because it's credit purchases. But then my increase in inventory, I did the same thing as well. Inked in inventory, and then I'm subtracting that as well. So then I get to total inflow of that amount, and then I get to outflow of that amount, and then I subtract the two, and it takes me to 2932 instead of the 2339. Fine. Then my operating profit is this one, remember? My depreciation is going to be that one, right? Or that one, whichever one you want to take. And then this is going to give me 3,102,428 Rand. You're going to remove your inventory increase. You're going to remove your trade receivable increase. You're going to add your increase in payables. You're going to get this total. You're going to add these two amounts. You're going to get your cash generated from operations, right? You subtract your interest paid, you add your interest received, and you're going to get this amount that we just calculated over there, right? That one over here. So your actual real cash flow. Fine. Then you purchase current assets, right? I mean non-current assets. So you're going to calculate, you're going to get the difference between these two to get the current, the non-current assets that you purchased. You're going to subtract it. And I'll show it here going off. Then your capital introduced, that is the 250, remember? And then you're going to subtract your drawings. You're going to add your long-term loan, which is 1.29, which is sitting over there. You're going to get your net cash from financing activities. And then you're going to do the sum of this. So this minus that plus that will give you your net increase in cash. And then your cash at the beginning, and then your cash at the end. Fine. On this side, so you'll see on this side, the difference is that you don't have these columns down here. Okay, they just end here. Fine. So now all you'll do is you'll take this and you'll put it there, that you'll put it there, you'll get the same balance that you have over here. That's your cash generated from operations, right? Then you subtract your interest paid, you subtract your interest received, and then you get your net outflow of operations, which is going to be the same amount as this one. So it's just a format difference, really. You're going to get the same answers. Then everything else is the same. As you can see, we have the 804 for 804, same over here. We have the 250 for the 250, the 301 for the 301, the 1.2 for the 1.2, the 123 for that. You get that. You get your cash at the beginning of the period. You get your cash at the end of the period. So those are cash flow statements. So when it comes to percentage change now, your percentage change, what you will do is you will take your old and subtract the new. So what you'll do is this. So say now I want to calculate my percentage change in my non-current asset value. I'm going to take the new, which is the 4575775. I'm going to subtract the old, which is the 3660 620 over the old, so the 3660 620, this is in brackets, multiplied by 100%, you're going to get an answer that is going to be in percentage form. That's what you're going to do there. So percentage change is not really like an issue, okay? The same with your ratios. So I didn't show ratios here. So you have a few ratios. I'll give you an example. You have an acid test. The acid test, you have your current ratio and acid test. So your current ratio, is going to be your assets over your liabilities, right? Your current assets. I'll take for 2020. So your current assets are sitting at 439,472 to your current liabilities of 886,085. Okay. So what you're gonna do is you're gonna divide your current assets by current liabilities. So let me just say equals here. I'm gonna say equals current assets divided by my current liabilities, and I get this answer. So for every one current liability, you can only cover 49% or 50% actually, 50%. So the company is sitting at a very bad position with that. And then if you took your asset test or your quick ratio, which is going to be your current assets minus your inventory divided by your current liabilities, you'll be at a worse off place because now you don't even have that 88,500 that you used to have. So you'll be at a worse off position. So that's how you will do your current ratios. Fine. Then jumping over to FIFO and weighted average methods. I'm not sure when I do this with an empty class actually. Okay, I'm gonna end the recording here. I'm gonna send you guys an email if you want to continue or not. And then if you don't, then I'll just stop it here. And then if you do, we'll do this with you guys tomorrow. All right.